Most business owners and operations managers stop reading their income statement when they reach the bottom line, net profit. But investors look at a different number. They care about return on equity, or ROE. This measures the exact amount of profit generated for every dollar of capital invested by the owners. Across most industries, consistently hitting a 15% ROE is the gold standard for a healthy, profitable business. But judging a company's health exclusively by its ROE is dangerous. It is like looking at a massive, solid building and assuming the foundation is secure without ever inspecting the steel underneath. As a standalone figure, ROE is highly susceptible to manipulation. It gives you the final score, but deliberately hides exactly how that score was achieved. Consider two competing manufacturing plants, Factory A and Factory B. Both factories report an ROE of exactly 15%. To an external investor, these operations appear perfectly matched. But the reality is completely different. One factory is highly optimized, while the other is standing on the brink of bankruptcy. How can two companies deliver the exact same return to their shareholders, yet carry entirely different levels of operational risk? To find out if a high return is from genuine operational skill or reckless financial engineering, we must break the metric apart entirely. In the 1920s, the DuPont Corporation developed a diagnostic framework, moving beyond simple ledger accounting to expose the structural mechanics of profit. We start with the bedrock equation. Return on equity equals net income divided by shareholders' equity. By taking this simple fraction and multiplying it by both sales and total assets, the math organically expands. That single top-line number splits into three distinct ratios, multiplied together. The first bracket is your net profit margin, the second is your asset turnover, and the third is your financial leverage. The DuPont analysis converts a flat percentage into a three-dimensional blueprint of the company's financial engine. The first lever, net profit margin, isolates the percentage of revenue left over after deducting operating expenses, interest, and taxes. This isolated ratio strictly measures your efficiency in creating value. It shows how well a company commands its pricing and controls its operational costs. Savvy operators will drill past the net figure and examine gross profit to expose the exact cost of raw materials and the financial impact of manufacturing waste. They will then check operating profit to identify any bloated administrative overhead or excessive sales and marketing expenses. If your profit margin is shrinking, the company's core product is losing its market power, regardless of how high your top-line sales figures climb. The second lever is asset turnover, calculated by dividing sales by total assets. This grounds the math in physical reality. It tracks how many times your existing machinery, real estate, and inventory cycle through to generate revenue in a given year. On the factory floor, a high asset turnover ratio looks like rapid, continuous motion. It requires high equipment effectiveness and inventory that moves quickly. A low turnover ratio exposes a sluggish operation.
It points to high machine downtime, idle floor capacity, and warehouses packed with dead stock. Buying expensive new machinery without driving proportional sales growth will mathematically crush this ratio. Asset turnover acts as a lie detector test for operational efficiency. It proves whether your invested capital is actively working or just sitting idle. The final lever is financial leverage, or the equity multiplier, calculated by dividing total assets by shareholders' equity. This ratio exposes how much a company relies on outside bank loans to finance its operations, compared to the owner's actual cash investment. Leverage acts as a financial steroid. By funding the business with debt, the equity portion in the denominator stays small, which mathematically multiplies the final ROE figure. An executive can make their financial performance look spectacular by borrowing heavily, without making a single actual improvement to the business. But that borrowed money requires strict, fixed interest payments, forcing the company into a much higher, more rigid break-even point. While extreme leverage aggressively inflates ROE during an economic boom, it rapidly accelerates the company toward insolvency the exact moment sales begin to drop. Let's return to the opening paradox. Factory A and Factory B both posted a 15th. Factory A commands genuine operational excellence. Factory B is one minor interest rate hike away from total collapse. Financial statements are just receipts of past operational behavior. To build a resilient business, leaders must use the DuPont model to diagnose the present. First, audit your gross margin. Verify that your actual production costs clearly align with your stated market strategy, whether that is a premium product or cost leadership. Second, hunt down asset traps. Locate any cash locked up in extended accounts receivable or warehouse deadstock, which heavily suppresses your turnover multiplier. Third, interrogate your ROE growth. If the top-line number is rising, verify if it is driven by actual profit efficiency or if management is simply borrowing money to buy back shares. But even with this advanced structural analysis, these financial figures are still lagging indicators. They only alert you after the damage has already occurred. To detect operational crises before they hit the income statement, managers have to track leading indicators like employee morale and customer satisfaction. Stop managing to the bottom line. True operational leaders build indestructible businesses by managing the precise mechanics of margin,